Welcome to Global Finance Uncovered. Every day, trillions of dollars, euros, yen, and other currencies crisscross the globe. This constant movement is not just about large corporations or governments, it underpins nearly every aspect of our interconnected lives, from online shopping to international travel. We're talking about the global financial network, an invisible system that powers modern commerce. Today, we delve into how money truly moves across borders, exploring the hidden structures and technologies that make it all possible, often in mere seconds. Understanding these mechanisms is crucial in our increasingly globalized world. Let's start with the basics. First, let's define global finance. It refers to the worldwide system of financial markets, institutions, and regulations that facilitate the flow of capital and investments across international borders. Think of it as the circulatory system of the world economy. It encompasses everything from foreign exchange, where currencies are traded, to international lending and borrowing, and the trading of global stocks and bonds. This complex web enables individuals, businesses, and governments to transact and invest far beyond their national boundaries. Experts confirm global finance is essential for economic growth. At the heart of global finance are currencies. A currency is simply a generally accepted form of money, including coins and paper notes, issued by a government and circulated within an economy. Each country typically has its own currency, like the US dollar, the euro for much of Europe, or the Japanese yen. When money moves globally, it often means one currency is being exchanged for another. This exchange is a fundamental step for international trade and investment. The value of these currencies constantly fluctuates against each other, a key dynamic in global financial flows. So, how do we know how much one currency is worth compared to another? That's where exchange rates come in. An exchange rate is the value of one nation's currency in terms of another nation's currency. For example, if the exchange rate between the US dollar and the euro is 1.10, it means $1 US can buy 1.10 euros. These rates are not fixed, they are constantly changing based on supply and demand in the foreign exchange market, influenced by economic indicators, political events, and market sentiment. Understanding exchange rates is vital for anyone engaged in international transactions. The primary arena for currency exchange is the foreign exchange market, often shortened to Forex or FX. It's the largest and most liquid financial market in the world. Unlike stock markets, Forex operates 24 hours a day, 5 days a week, across major financial centers globally. Its sheer scale is staggering. Recent reports, like those from the Bank for International Settlements, indicate that daily trading volumes are in the trillions of US dollars. This immense activity highlights the constant need for currency conversion to facilitate global trade, investment, and capital flows. It's a truly global marketplace. Now, how does a bank in New York tell a bank in London to transfer money? They use a secure messaging network called SWIFT. SWIFT stands for the Society for Worldwide Interbank Financial Telecommunication. It's not a bank itself, and it doesn't hold or transfer money. Instead, SWIFT provides a standardized, secure messaging system that allows financial institutions to send and receive information about financial transactions, such as money transfers. Think of it as the postal service for global banking instructions, ensuring messages are accurate, secure, and authenticated. It's the backbone for millions of cross-border payments daily. Let's trace a simplified money transfer using SWIFT. When you initiate an international transfer from Bank A to Bank B, Bank A sends a SWIFT message to Bank B. This message contains all the details: your account number, the recipient's account number, the amount, and currency. Bank B receives this message, verifies it, and then credits the recipient's account. This process is highly automated and relies on unique SWIFT codes, also known as BIC codes, for each financial institution. These codes ensure that the message, and thus the money, goes to the correct bank, anywhere in the world. It's a seamless, secure handshake between banks. Not all banks have direct relationships with every other bank globally. This is where correspondent banking comes in. A correspondent bank is a financial institution that provides services to another bank in a foreign country. For example, a small regional bank in Germany might not have a direct connection to a bank in Japan. Instead, the German bank might use a larger international bank, its correspondent, which does have a relationship with the Japanese bank. This network of correspondent banks allows smaller institutions to offer international services and facilitates payments across jurisdictions, forming a crucial link in the global chain. It's a system built on trust and established relationships. Beyond SWIFT, there are other crucial interbank networks that support payment processing. These are systems through which banks transfer funds to each other. Examples include Fedwire in the United States, Target2 in the Eurozone, and SHAPS in the UK. These systems process high-value, urgent payments between member banks within their respective regions. While SWIFT handles the messaging for international instructions, these interbank networks handle the actual settlement of funds on a gross basis, meaning each transaction is settled individually. They ensure the finality of payments, often in real time or near real time, within a country or currency bloc. When governments or corporations need to raise large sums of money, they often issue bonds. A bond is a debt instrument where an investor loans money to an entity, which then promises to pay interest over a specified period and repay the principal amount at maturity. Think of it as an IOU. Government bonds, for instance, are issued by national governments to finance their spending. They are considered relatively low-risk investments and are a crucial component of global financial markets, allowing capital to flow from investors in one country to governments or companies in another. This cross-border flow of debt is immense. Stocks represent ownership in a company. When you buy a company's stock, you own a small piece of that business. Companies issue stocks to raise capital for growth, and investors buy them hoping their value will increase, or to receive dividends, a share of the company's profits. Global stock markets, like the New York Stock Exchange or the London Stock Exchange, allow investors from anywhere in the world to buy shares in international companies. This enables global allocation of investment capital, driving innovation and expansion across borders. It is a direct way for individuals to participate in the global economy. A more complex financial instrument is a derivative. A derivative is a financial contract whose value is derived from an underlying asset, group of assets, or benchmark. These underlying assets can be stocks, bonds, commodities, currencies, interest rates, or market indexes. Derivatives are used for various purposes, including hedging against risk or speculating on future price movements. For example, an airline might use a derivative contract to lock in a future price for jet fuel, protecting itself from price increases. These instruments are a significant, albeit often opaque, part of the global financial network, allowing for complex risk management strategies across borders. Global finance isn't uniformly distributed, it concentrates in key financial hubs. These are cities that serve as major centers for international banking, stock exchanges, and financial services. London and New York are two prime examples, each with distinct strengths. London, strategically located between Asian and American time zones, is a leading center for foreign exchange trading and international debt markets. New York, home to Wall Street and the NYSE, is dominant in equity markets, investment banking, and capital raising. These hubs act as vital nodes, channeling capital and expertise across continents, driving much of the global financial activity. Central banks play a critical role in managing and stabilizing the global financial system. These are national institutions, like the U.S. Federal Reserve or the European Central Bank, responsible for a country's monetary policy. Their mandates include maintaining price stability, controlling inflation, and promoting economic growth. They do this by setting interest rates, regulating commercial banks, and acting as a lender of last resort. Through international cooperation, central banks work together to prevent financial crises and ensure the smooth operation of cross-border payments and capital flows. Their decisions have ripple effects across the entire global economy. Technology is rapidly transforming how money moves. Artificial intelligence, or AI, is increasingly being deployed in finance to automate processes, detect fraud, and make quicker, more informed trading decisions. AI algorithms can analyze vast amounts of financial data at speeds impossible for humans, identifying patterns and predicting market movements. For example, AI-powered systems are used in high-frequency trading, processing millions of transactions per second. They also enhance cybersecurity, protecting financial networks from sophisticated attacks. This integration of AI is making global financial transactions faster, more efficient, and theoretically, more secure. It's an undeniable force. Blockchain technology, the decentralized ledger system behind cryptocurrencies like Bitcoin, is also making waves in traditional finance. A blockchain is a distributed, immutable record of transactions. Instead of a single central authority like a bank verifying transactions, a network of computers collectively validates and records them. This technology offers potential benefits for global finance, including faster settlement times for cross-border payments, increased transparency, and reduced costs by cutting out intermediaries. While still evolving, various financial institutions are exploring blockchain for everything from payments to trade finance, recognizing its disruptive potential. Building on blockchain, cryptocurrencies like Bitcoin and Ethereum represent an alternative, decentralized way of moving value. These digital assets are not issued by any central bank or government and operate independently of traditional financial systems. While highly volatile and still facing regulatory challenges, cryptocurrencies offer a potential avenue for faster, cheaper, and more direct international transfers, bypassing many traditional intermediaries. However, their adoption in mainstream global finance remains limited due to scalability issues, price volatility, and regulatory uncertainty. They are a powerful, but nascent, force in the broader landscape of money movement. Many view them as the future. The way we pay has evolved dramatically, influencing how money moves globally. From physical cash and checks, we've moved to sophisticated digital payment systems. These include credit and debit cards, online payment platforms like PayPal, and mobile payment apps. Each innovation has aimed to make transactions quicker, more convenient, and more secure. Globally, this evolution means less reliance on physical currency and more reliance on electronic data transfers. This shift has significantly accelerated the pace of international transactions, enabling instant cross-border purchases and remittances, a far cry from the multi-day processes of the past. The trend is clearly towards digital solutions. With increasing digitalization comes heightened risk. Cybersecurity is a paramount concern for the global financial network. Financial institutions are prime targets for cyber attacks, which can lead to massive financial losses, data breaches, and a loss of public trust. The interconnected nature of global systems means a vulnerability in one part of the network could potentially have widespread repercussions. Banks and financial regulators invest heavily in advanced security measures, encryption, and threat detection systems to protect these vital networks. Safeguarding these systems is an ongoing, evolving battle that requires constant vigilance and innovation. To maintain stability and integrity, the global financial network is governed by extensive regulation and oversight. National governments, central banks, and international bodies like the Financial Stability Board and the Basel Committee on Banking Supervision work to set standards and rules. These regulations aim to prevent financial crises, combat money laundering, counter terrorist financing, and protect consumers. Compliance is complex and constantly evolving, ensuring transparency and accountability across borders. This framework of rules is crucial for building trust and ensuring the smooth, secure, and ethical functioning of the vast network that moves money around the world. What does the future hold for money movement? Trends suggest continued digitalization, greater integration of AI and machine learning, and increasing exploration of blockchain and central bank digital currencies, CBDCs. These innovations promise even faster, cheaper, and more efficient cross-border payments. We may see a shift towards programmable money where transactions are executed automatically when certain conditions are met. However, these advancements also bring new challenges in terms of regulation, interoperability, and cybersecurity. The global financial network is not static, it's a dynamic, living system, constantly adapting to technological progress and geopolitical shifts. From the intricate web of correspondent banks to the lightning-fast transactions powered by AI and the emerging potential of blockchain, the global financial network is a marvel of human ingenuity. It's a system designed to move value efficiently across borders, connecting economies and cultures. Understanding these hidden systems demystifies the seemingly complex world of international finance, empowering you with knowledge about how global commerce truly operates. This network is not just about numbers, it's about connecting people, facilitating opportunities, and shaping our collective future. Thank you for joining us on this journey to uncover its secrets.